Okay, I've got everything I want up here and ready to go. All right, let me know when we're on. Oh, we're on. Hey, everybody. Welcome. Happy to see you here. We've been covering a lot of sort of high-level topics as far as trading is concerned in the last few days. I'm Rob Booker. Welcome. Glad to see you here. Don't forget to subscribe to the YouTube channel. Click like. Leave a comment below. We'd love to know where you're from. We'd love to stay in touch with you. So anyway, we've been talking a lot about high-level trading-related concepts like, how to build a position, why building a position is more important than treating trading as some kind of binary gambling exercise. And in today's video, I want to talk about sort of how we take that one step further and how you actually might build a position, what it means to actually do it. So it's one thing to talk about it in a theoretical sense, and it's another thing to actually do it. And I want to use some charts today to show you exactly that. So I've got Carrefour, the European store. I've got a chart up here, and if you, Nate, can try to pull up the drawing mechanism here, we'll do that. So let's say that I'm really interested in buying this company's stock. Let's say that I love this company. Let's say I love their market position, I love their profitability, I don't know. I mean, I'm just making stuff up. Let's just say that I love it. Let's say that my analysis shows that I want to buy it. Or let's say that technically I've decided that buying this company is a great idea. So that's awesome, that would be fantastic. Let's say that we've decided that this is the company that we want to buy. Well, I'm going to show you how I make that decision, and then I'm going to offer you some insight into how someone might go about building a position once they decide that. All right, so Nate, what's happening over there? It's just non-responsive. Okay, so it does look like it's non-responsive, doesn't it? So it might be, so you can just let that go. We might just close out a bunch of windows here, and we might find that something else is sort of controlling. And it looks like that's the case. It looks like something else is running the show here. So we're going to close this window. Yep, we're going to try to close Chrome. And then we're going to try to close PowerPoint, and we don't want to save anything. And then we're going to go back to FX Pro, and then we're going to try to draw, and that was it. So something else was controlling our little magical screen. So I'm going to show you how I make the decision to build a position and how I go about it technically. So on the chart here, you can see just barely underneath these bars and candles, it's a really sunny day out there, so you can see the glare from behind my desk over there. But that's not going to worry. That's not going to matter. This is Knoxville divergence. It's an early warning sign that price is going to go up. Now, I have a long history of looking for Knoxville divergences on stocks after earnings. And let's just say that Carrefour, or however you pronounce it, reported earnings on that white line right over here, and then it produced bullish Knoxville divergence right here. And so I go, oh, wow, well, that's everything I look for. I'm going to buy it right there. Now here's what I'm going to do based on the principles that we've discussed in the last few days. Even if I do love it, and even if I'm going to buy it, let's say that I'm working with $10,000. Let's just say that's my account size. I'm working with $10,000. And let's say that the stock is trading at $17 at that time and 30 cents. Now I know this sounds absolutely insane and doesn't even seem like, I might just buy 10 shares. What most people will do if they've done all this analysis up to here in exactly the same way or a similar way is most people will just go whoosh and roll those dice. They'll blow on them. They'll dress up a lady in a pretty sparkly dress, and then they'll hand her the dice, ask her to blow on the dice, and then they'll go for it. And they'll just do this like they are at Monte Carlo, or they're James Bond in Casino Royale. Doesn't end well. Every single time that goes absolutely insanely bad. And so knowing that I might have to build a position, knowing that there's no guarantee that this is going to work out, knowing that I only really have a 50-50 chance of this trade going in my favor, even if you think your statistics are better, they're not. That's how I feel anyway. So I go small. Small position size is the holy grail of trading. The holy grail of trading isn't an indicator. It's like Dan Brown in the Da Vinci Code, or whatever. Didn't he say something like the Holy Grail wasn't a grail, right? He said something like that? I don't know. The Holy Grail of trading isn't an indicator or a strategy. It's position sizing. And here's why. So I go in with a small position size. Now, if this position is a winner, if right off the bat I buy it here and it starts to go up, I can add more positions. I can add to a winning trade. I can invest more heavily in what is working. That's awesome. Sorry, that was lewd and crude. But I get excited about it. So let's say that we do that. Let's say we get in here and it goes up. But what happens instead if that doesn't happen? What happens if instead this goes down? So let's go back in time, Huey Lewis and the News and Back to the Future, and let's look at an example of what this might look like. Oh, I see what happened. I see how you're going to be MetaTrader. Well, I don't accept it. I'm going to go back in time if I want to. All right, here we go. So let's say we're going to do this. Let's say that we buy on this Knoxville divergence. Let's say it's after earnings, and let's say that the stock is trading at $20. All right? I know that's inside of a glare, but you can probably see that just fine. I buy it here. And let's say I buy 10 shares. And let's say that I spend $200 of my trading capital to do it. If this stock goes to zero, I've lost $200. Big, fat, hairy deal. I've lost 2% of my account. So what? Doesn't matter. No big deal. Now, what most people will say is, oh, but Rob, if it goes in your favor, if this trade goes up and it goes, up to $21, because you bought 10 shares, you'll only make $10. And they'll say, ha ha, you're a terrible trader. They'll say, ha ha. Some guy on YouTube, Nate, left a podcast comment that said he called my glasses funny looking. He called me funny looking. Like, in this day and age, we're still making fun of the way people look. Anyway, so I pulled up a picture of Dustin Hoffman from Tootsie, and I said, that's the next pair of glasses I'm getting. Okay, so some people go, ha ha, that's $10. You're a loser. You're not a real trader. You only made $10. Let me explain to you. I'm going to use some complicated math here. So stay with me. We're going to do some math. I'm going to work out an equation, okay? So we're going to go y equals mx plus b times e equals mc squared equals most traders make nothing. That's the equation. Most traders make zero. So if you make $10 on a trade when it goes up, and you want to cry about it or you want to make fun of somebody making money, then you're a dummy. You're a total dummy because most people are making zero. Let's say we buy here. So we buy it there. And let's say it does start going up. I can add 10 shares, 10 shares, 10 shares, and 10 shares. Now, commissions are so ridiculously low. I don't even pay commissions because I'm trading on Robinhood right now. But you could trade with brokers in the US that are all you can trade for a set monthly amount. There's all kinds of great deals now. So I just keep buying as it goes up. And I've turned 10, 20, 30, 40. Maybe I make $40. And maybe I just add that to my account balance. Great. I've turned a small first trade into something slightly more substantial. But because the position size is small, if I'm wrong, it doesn't matter. The goal of trading isn't to make money. The goal of trading is to minimize the effects of being wrong. And it's one step more than that. The goal of trading is to turn being wrong into money. The goal of trading is to not just survive when things go wrong. It's to thrive when things go wrong. Most people think the goal of trading is to make money. Great. Have a nice day with your goal. Have a nice day increasing your trade size. Have a nice day blowing up your trading account. Fine. Fine. Whatever. I don't care. I've been doing this for 20 years now, and I've never met one person who made money the most important thing and then thrived. I've met lots of people who made risk management the most important thing. All right, once again, this could be a stock, this could be a currency, but we're doing stocks today because I always talk about currencies, and I just wanted to change it up a little bit. So we bought here. and we were wrong. Most traders, when they're wrong, have lost a lot of money. And Nate, how do you think that they feel about themselves and trading and whatever else? Probably not so great. They have trouble, expressing. They go home and they're upset and they're mad at their family and they're just generally miserable because they made the wrong decision and so much was riding on being right. If your whole life depends on you being right a lot, just your whole life's going to stink. It's going to be terrible. However, because I traded a small position size, and because this dropped from 20 down to 16, so I bought 10 shares, I lost $4, I lost $40. Around this time, I hear from the people who go to the Church of Van Tharp, who say, oh, your risk is bigger than your reward. No, it's not. If I'm going to add to a winning position, then my risk is smaller than my reward. Meaning, I lost $40 as this trade went against me. No problem. I could have made $40 or more if I added to the trade as it went in my favor. So I don't have a risk to reward problem. So everybody just calm down. I'll also hear from the crowd, it says, why didn't you just close this trade out? Why didn't you just close that trade out? Why don't you just stop out of that trade? Because every time in your life and mine, with very few exceptions, that you search for the system that has the perfect stop loss, the market's going to find a way to make sure you know that that's not the perfect stop loss. There is maybe no way to tell how far something's going to go up or how far something's going to go down before turning around. So what I do is I'll have a maximum loss that I'll sustain. But I start so small that I'm not going to hit that under most circumstances. Okay, here we go. We've dropped $4. We've printed a brand new Knoxville divergence. So I buy it again. Once again, I'm building a position. I'm building a trade. Now some of you will say, oh, that's martingale trading. No, 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 no. That's what Sean Campbell would call inventory trading, and that's what a bank would call trading. That's what a bank would call trading. That's what a professional trader would call trading. You're going to bring things into your inventory, and the better the price gets, the more you're going to bring in, and you're going to do it in small, tiny, small, little bits at a time. And then you might wait on price coming back up to $19. That means we've lost $1 on the first position, and we've made $3.50 or more on the other position for a net win of $2.50. And if you added to the position as price moved in your favor, then this is an even bigger win. And what we've done is we've built a position. Instead of thinking about, I've got to win or I've got to lose, I've got to pick the right stop, we've built a position. The reason this works so well for me, and it works for people who trade at a bank desk or whatever else, the reason this works is instead of trying to find the perfect spot to stop out so you can keep your stop loss tight, you're building a position and you're gonna push on it until you get an outcome that's favorable to you. And you might have a max loss the whole time of 2%. You might just have a loss. So if you lose $200, you might be out of the whole thing. So fine, if you lose $200, you're out. So you still have a maximum loss, but you do everything you can to keep your trade size so small that you don't hit that you give yourself plenty of room to build a position. And you think of yourself as a bank trader who's bringing things into your inventory, and you're warehousing this stock, and then you know at some point you're going to offload it when you get a favorable price. And you're building this, you're constructing this, you're thinking about it in more than just gambling, binary, rolling the dice, wins and losses terms. The reason this is more effective is because once again, it focuses on the holy grail of trading. And I'm not going to be able to pull up my whatchamacallit anymore, so who cares? Doesn't matter. Who cares? The reason this is so effective is that when you trade this way, you have to keep your position size small. And if you keep your position size small, then you're perfectly fine. If you keep your position size small, you will win. You will eventually be able to win. You will eventually be able to construct positions and build trades using your trading system. And you will be able to win a significant amount of the time. And you will occasionally lose 1 or 2%, as we've talked about. But you will, by using small trades, be able to build your way into a better position. Because we can't time the market. It doesn't work. We don't know when it's going to turn around. And if someone out there can, then this YouTube channel, and I'm not for you. I'm not smart enough to be around you. But when you trade the binary method, as we have been talking about, which is ones and zeros, where you either win or you lose and you keep your stop loss really tight, what this encourages people to do is they'll justify a much larger position size because they're going to stop out. And then one day the market crashes and their stop can't get honored. And then one day they have to take the dog to the vet and they forget to place their stop loss. And then one day life gets in the way and they don't stop out at that really, really, really tight stop loss level. They break the rules and the penalty is enormous. Earlier on at the beginning, I said the goal of trading isn't to make money. It's to minimize the effects of being wrong. And if we take it a step further, it's to maximize the benefits of being wrong. What if every time you were wrong, you got better? What if every time you were wrong, you got a better price? What if every time you were wrong, something magical came in as a silver lining? When the housing market crashes again, and it will, there will be winners and losers. The losers will be the people who went in too big when prices were high. The winners will be the people who went in small when the price was high and then added as the market dropped and got things at a great price. In other words, when things were going wrong for everyone else, they were going great for the people who were playing the small game, the game to win, the long game, the long-term game. Anyway, when we come back tomorrow, what I'd like to discuss, I'd like to take this a step further, and what I'd like to do is kind of sort out how you go about constructing something or a routine that would help you do something like this. As always, the link to my mentorship program is below this video or around this video. It's somewhere floating around this video, and I'd love to work with you. Lots of great stuff are coming down the road. We have some of our best students teaching classes, helping others. I'm teaching classes. The best students are teaching classes, and there's a whole lot more of that to come. If you're interested and you feel like the time is now to do this kind of stuff together, then click the link below, watch the video, fill out an application. I'll take a look at it, and I'll get back to you. I'd love to work together. I'm Rob Booker. Thanks for watching the channel. Don't forget to subscribe. Don't forget to like. I will see you tomorrow. Bye for now, everyone. And thanks, Nate, for running the camera.